Hello, everybody. Happy Friday, and welcome back to CoMotion Labs Fundamentals for Startups. I am Brady Ryan, CoMotion Labs Hardware Incubator Manager. If you've joined us here before, you know that CoMotion Labs is University of Washington's effort around startup incubation. We operate 3 incubators here on campus, one for hardware startups, one for life science startups, and one for software and tech startups called Startup Hall. We don't take equity in any of the startups we work with, and we don't want any of your IP. We just want to work with you and help your startup succeed. So if you're a founder looking for somewhere to live and incubate your startup, give us a call. We have some capacity, and we're always looking for great folks to work with. While we wait a couple minutes for everybody to join us, I'll make a few quick announcements. This, sadly, is our last week of the Winter Fundamental Startup Series. We're going to take a little bit of time off and resume on Friday, April 1st with a hardware theme series. This is near and dear to my heart as I run the hardware incubator here, and we hope that you'll join us to learn about how hardware is hard. Until then, all of our Fundamentals for Startups presentations are archived on our CoMotion website under Innovation Training Videos. We've covered a variety of topics over the last several years, so if you find yourself with some free time, please feel free to check out the past talks. For the full schedule of our events and to register for future Fundamentals, please visit bit.ly/CoMotion Fundamentals. Also, please subscribe to our YouTube channel and click the little bell so you'll be notified of our future live streams. Fundamentals for Startups is funded in part by a grant from the Economic Development Agency. We'll be dropping a link in the chat to a short survey. Please tell us who you are and where you're watching from and how you heard about this event. This really helps us keep the EDA on our side, so they let us keep doing this. Finally, CoMotion has partnered with BECU over the past 3 years to support the growth of Fintech in the Puget Sound region. To date, we've supported 11 Fintech startups through BECU's Fintech Incubator. If you would like to apply to be part of the next cohort, please visit the website you see on the screen. We'll also drop a link in the chat. We hope we have some good Fintech folks around based on today's topic. So take a look at that. It's a fantastic program. Today, Dave Wong is here to present Building Enterprise Fintech Startups. Dave has extensive sales and product experience in investment banking enterprise software. He currently oversees the product development of Salesforce for Wells Fargo Securities. His prior experience includes working in trading, risk, and compliance technology for investment banks, hedge funds, and various early-stage fintech startups, which have since become part of Fiserv, CME, MSCI, Thoma Bravo, and Ion Trading. In this presentation, Dave will share his experiences working in the industry over the past 2 decades. Dave will take questions via chat. Please feel free to chime in during the talk on a little sidebar over there, and I'll now turn the event over to Dave. Dave, thanks for being here.
Great. Thank you, Brady. And thank you, everyone, for having me today. Before I get started, I just wanted to, say I hope this is something that what I'm going to be talking about today is actually an area, and it's a vertical that is probably not something that you typically think about when you think about fintech, but it is a vertical. It's a very significant vertical out there. And, I hope to shed some color and light about, this particular pathway, if this is something that you'd like to consider or find out more about. So let's start. Okay, so I'm just going to start off with, what is fintech? And most of you are probably familiar with the consumer side of fintech. So, especially over the past couple of years, and like a lot of the buzz around fintech has been around things like, crypto and NFTs, particularly around COVID. There's been a rise of retail trading with everybody at home and, downloading things like their Robinhood, Webull, or Coinbase apps, following their favorite social influencers and, getting involved with trading, whether it's equity trading, options, or crypto. There's also, you might think of fintech as, say, payments. So like, when you're out with friends or you need to pay for, buy anything off of Facebook Marketplace or something like that, there's, apps that we're probably all familiar with, such as Venmo and Cash App. And then lastly, how we make payments online. So PayPal, like being a classic example. So I think this is the world of fintech as most people see it. But there is more to fintech. And what you're probably not as familiar with is actually fintech as it powers like the greater capital markets. And, just to throw a few data points out there, if you look at global equities in the world and, all of the stock trading that occurs, that's $125 trillion market. If you look at what's called the derivatives market, the derivatives market is even greater than that. Depending on, what quarter or what year you're actually looking at this has been sized at anywhere from a $600 trillion notional market, to upwards of 1 quadrillion in notional contracts outstanding. So, just to give you a sense of the magnitude, I worked for a particular investment bank where just to, when we're talking about real-time data, we think about like all of the likes and comments that you see on social media. Within the investment bank, within a sales and trading operation, we were publishing 230 million quotations a day. So, if you think about just the amount of data and the analytics and the technology required to actually execute that sort of activity and make sense of that information, this is something that happens behind the scenes that's really, general public's not generally aware of. And if you think about just the size of trading activity, if you're thinking about money that's moving through the financial system, if you're thinking about things like quotations and all of the processing that's going on associated with that, there is a surveillance function. And if any of you recall the financial crisis in 2008, we had a case where we had banks which back then were deemed too big to fail. And when they actually did fail, the ripple effects throughout the financial system were massive. So since then, over the past 15 plus years, there's been huge efforts across industries, across the globe and across different geographies to basically monitor the state of the financial markets. And if you think about how that surveillance happens, that's all through technology or, through Fintech. So some of the names that I have here, like ICAP, IHS Markit, TradeWeb, CME Group, ION, MSCI, these are not necessarily household names, but these are very, very important fintech companies that kind of underpin the capital markets and how they function on a day-to-day basis. And, that's what I wanted to give you a bit of insight into today. So if I talk about enterprise fintech, for the purposes of today's talk, I'm really going to be focusing on, enterprise, or what I'm calling capital fintech, capital markets fintech. And that's really at a high level, just in the intersection of the capital markets and investment banking enabled by technology. So I'll go through, a couple of examples to illustrate this, and then I'll talk a little bit about my experience, starting off my career in this particular area, which was actually, which was the intersection of finance and technology before there even was a term called fintech. But that's what it's evolved into.
Hey, Dave, I've got a question for you. I wondered if you could kind of define capital markets or investment banking for anybody in the audience who doesn't know. What's the point? What are they trying to do? Who are some players? Just kind of help level set for everybody.
Sure. So let's start with investment banking. So investment banking is all about, if you think about consumer and the wholesale side, basically investment banking is focused on the wholesale side. So the retail side would be things like, everybody has a bank account, right? And or as a small business, you go in to get a loan or you make deposits, right? So that sort of loan deposit commercial small business relationship is typically what we call retail banking. Okay. Wholesale banking is typically broken out into two big buckets. So there's going to be advisory. So advisory is typically what you think about as M&A. When you hear about IPOs, or basically when Coca-Cola needs to finance, the funding of a new product line, or they're building a new plant, right? They're going to go work with an investment banker, and that tends to be more advisory work. So that's one side of the investment bank. The second side of investment banking has to do with like the balance sheet. So the money that the bank is sitting on, and basically that falls under the sales and trading umbrella. So if we think about advisory on one side, there's sales and trading on the other. And
Okay.
basically that's the world that I'm going to be focusing on today. So there is technology involved with advisory. I'm going to be talking about more of the market side of things. So this is basically, helping companies raise money, to basically, place issuances or equity into the marketplace. And, when we have things like public offerings, when debt is being issued and how that's being bought and sold on the primary and secondary markets, that's what we call the capital markets.
Okay. And that ends up kind of being the enabling function for the economy to work then, it sounds like. I mean, these
Yeah,
are
so if you think
really
about
important core pieces to how the world works and how it enables companies to operate.
exactly. So if you think about, fundamentally with, firms looking to raise money, for instance, like they would raise money through the capital markets. And then over time, as exchanges, as products such as derivatives came into play, there's other activities that go on, such as hedging or speculation, for instance. And these are all activities that happen in the capital markets. And if you think about that, the capital markets and the amount of buying and selling and movement of equities and other securities is like orders of magnitude larger than anybody trading on their Robinhood accounts, collectively.
Yeah, sure.
Sure. So does that answer your question?
Yeah, absolutely. Perfect.
Great. So before I kind of get into, what is enterprise fintech and whatnot, I thought of, maybe an example. So, anybody that, is a foodie, for instance, that's into Iron Chef, they always start off with this quotation about, I will tell you what you are if you tell me what you eat. So in this case, what I wanted to lead off with here was basically a bunch of my personal experiences, and then I can back into, my part in all of this. So what you have here with this kind of tiled infographic here are probably names, financial disasters, or names that you're seeing popping up in the headlines these days. So, if we rewind the clock, you may have heard about long-term capital management, which was like the largest, hedge fund flameout in history. I'm sure most of you have heard of Enron, or Lehman Brothers and Bear Stearns and their association with the credit crisis. There was another, big scandal in the past decade about how banks were colluding to manipulate interest rates. So Deutsche Bank was one of the major players there. And I think recently, if we look at to what's going on right now in Russia and Ukraine and all of the sanctions against Russia, and you may or may not have heard about like the SWIFT payment network and basically how Russian institutions are getting delisted from that network. So you'll hear names like Sberbank and VTB. So these are all institutions that I had firsthand experience working with. So, dating all the way back to hedge fund flameouts. When we looked at the rise of the dot-com era, Enron was a big part of that. The credit crisis, I was heavily involved and very intimately involved with companies like Bear, like Lehman, like AIG Financial Products, and a number of others. I do a lot of regulatory work now with banks like Deutsche Bank and others that are looking to safeguard against, interest rate manipulation. And I guess when we look at like some of the Russian banks, like I think part of what you do in this industry is that, you are providing innovation, and innovation does not stop at geographical lines. So, if you have European, American, Asian big banking clients that are using your software, for instance, the emerging markets are to follow, and you find yourself in some very interesting situations. So I'll talk about more about my involvement in some of these entities as we go on. Okay. So let's kind of take this back to basics for a second. And in terms of, fintech, like what is fintech? And, very simply, it's really just the application of technology, and that technology can come in the form of software, can come in the form of services, data tools, some business process optimizations to basically either enhance or to disrupt the financial services domain. And finance in itself is actually a very, very large landscape. So if you look at like a CB Insights infographic here, this gives you a sense of like, all the different areas of finance that, are benefiting or getting disrupted by fintech companies currently. For me personally, like if you look at everything highlighted in yellow, this is my personal experience. So, in a nutshell, in the wholesale capital markets, kind of ticks off the capital markets box, regulatory and compliance, real estate and mortgages. Why that's particularly interesting is that here in the United States, a lot of the capital markets are based on the US housing market. So, but the US housing market, that spins off like a whole industry around interest rate and credit products, because that's all underpinning all of that are securitized products, and under that are mortgages and other debt-related instruments like credit cards and auto loans and whatnot. So that's a very interesting space. There's also what they call the buy side. So you may have heard of hedge funds or asset managers, those firms that are looking after pension plans and whatnot. That's the asset management space, and there's a lot of fintech involved there. The core banking and infrastructure space is very interesting because over the past couple of decades, there's been periods of financial transformation. So, when I started off in this industry 2 decades ago, it was all about innovation. So back then, if we looked at banks such as JP Morgan and Goldman Sachs, there was a time where they had more technology. They were more technology players than technology companies themselves, or they like to brag about. And so they were building things out. So they were building out better trading systems, better risk systems, better analytics. And then over time, what happened is that as they were focusing more on their finance, their sales and trading businesses, basically their technology started to lag when you started to have the .com era. And then now you have, companies like the FANG companies, and these are pure technology plays, and their technology capabilities have overtaken, what the banks were able to do back then. So that in itself gave the rise to fintech, because the banks started to say, okay, we're going to start focusing on what we do best, which is going to be, say trading financial products, offering financial services to our customer. And then everything where we're not competing, we are going to spin that out. And that's what became the fintech industry in itself. Okay, so I'll talk.
So a question for you, in those days when, Lehman Brothers, Goldman Sachs were kind of leading the charge on technology, was that all being built in-house, or were they
Yes.
acquiring startup companies at all? They were just tech companies that happened to play with money a lot.
Well, we're rewinding the clock now back to probably even as far back as the late 80s and 90s.
Okay.
Back then, it's like, where was all the cash sitting? They were sitting with these banks that were, trading, in finance, right?
Mm-hmm.
And I think, there was an early recognition that if they brought that in-house, then that was their IP, because if you can create algorithms, or if you can create frameworks or optimizations that allowed you to build a better mousetrap than the competitors, and that was your IP. And so that's what they did. But I think over time, just as we all know, technology evolves so fast. And if you look at banks and other financial institutions, that's not their core remit. Their core remit is return on investment or return on equity, right? And so, you can't do too many things and be expert at everything. So therefore, there were the parts of their business that they were actually competing with other banks against. And then there were also the other portions of their technology stack or operations, which were kind of commonplace. And there was no point in building a better, payment processing, if there's no secret sauce. And those, when the bank started to look at basically stripping out those non-core pieces, that's basically what became fintech.
So then a question, if we just bounce forward 30 years, 40 years to now, or 30 years, I guess, are big banks or the folks in the capital market, are they more likely to, are folks still building anything themselves? And then when they're not, when they choose to buy, are they acquiring companies so that they hold that entirely and that's a competitive advantage? Or are they just licensing seats? Are they going as a customer to somebody rather than trying to acquire early stage startups?
Yeah, so there's various approaches, and I'm just going to speak in general terms here. But basically, what a lot of banks are looking at now is they're looking at their operations and they're looking at what's non-competitive, and they are basically allowing those groups to leave the banks or other financial, it doesn't have to be just banks, but I just use it as a proxy right now, and to basically incubate startups. And the whole idea there is that as a startup, there's economies of scale, because now as a independent startup, if now you don't just service bank A, but if you can service a whole, a whole demographic, right, a whole sector, then you can start to achieve economies of scale as maybe a utility as opposed to, a unit that belongs to a single institution.
Mm-hmm.
And then as part of that, what a lot of banks will do is that they will actually take an equity stake in these startups. And so what happens is that when you have like a bank that has an equity stake in the startup, if at some point that startup really takes off, one, the banks have the equity upside. And then two, that provides validation that, okay, there is something here. And, there are cases where financial institutions will buy them out. We'll take out the startup and bring them in-house because it is deemed to be competitive, like a competitive advantage. Does that make sense?
Yeah, it does. Are there, so, you kind of mentioned that it's not just banks, but we'll use banks as a shorthand. If we get outside of that, are there different types of players who are more or less likely? Are you seeing that hedge funds are super forward looking and want to partner with startups more so than, say, I don't know who the other players might be, like a real estate, like a large lender, I guess, for mortgages? I'm thinking if I am a fintech startup, I'm looking for partners, I'm looking for pilots, I'm looking for customers. Are there any kind of macro trends around the different players about who is better to target than others?
Well, what you will find is that they will so proprietary firms like hedge funds, where they are all about just alpha generation, and what that means is just making money, right? So again, I go back to, you can't be like an expert in making money and then an expert in building predictive analytics to find out what stocks to buy in the case that we have a global recession, right? Those are two very different domains. So what you tend to find is that hedge funds, investment banks, or anybody in financial services will partner with technology firms, because if you think about the nimbleness of being a fintech provider to the financial services industry or any industry, you are a market practitioner. You are not a specialist in a domain, but you talk to everybody in the space. And so therefore, you have a much broader viewpoint of what anybody working in a siloed function would have. So therefore, it's almost a symbiotic relationship where if you have a hedge fund or an investment bank, they will talk to fintech companies, because the fintech company gives them market color, and it will give them best practices, like, hey, what's Goldman Sachs doing? What's JP Morgan doing? Without naming names per se. Yeah. Those market practitioners do have those sorts of insights that somebody focused on a day-to-day job within a bank probably would not. Now,
that's an interesting insight. You always think about kind of exclusivity with a technology provider like a startup, for instance, or just a financial services provider. Exclusivity being a competitive advantage, but the point you're making is that can be a competitive disadvantage because you're getting such a siloed look, and that those vendors that cut across multiple banks, we'll call them, have a bunch of perspective that you wouldn't have if you're just sitting in your cubicle pounding away on spreadsheets the whole time.
That's right. And I think having said that, if there is a fintech company out there that does offer, really compelling competitive advantage, no hedge fund or bank is going to want to share that with any other
Sure.
participants in the market. So, there are these kind of carve outs, and you'll see this with like large financial technology firms like Bloomberg back in the day. And you'll see that with a lot of the vendors that help banks increase their top line, for instance, like they will kind of wall off those relationships. Like, they'll have separate teams within the fintech organization that are dedicated to one client, for instance. And that's to
Sure.
keep the information bleed from happening. Okay. All right. So basically, in a nutshell, to give you an idea of what these enterprise fintech companies do for the financial institutions, these are just 6 buckets. And I'll start off with like product and business model innovation. So if we rewind the clock, like if we're looking at, say, crypto and distributed ledgers and DeFi and things like that right now, basically, there are companies that are very nimble, that are early adopters to these sorts of new technologies. And they work with the banks to help them understand like where this fits into their service offerings or their product portfolios or why they should care. So, to our point earlier, it's that banks are, they're focused on their day-to-day. Startups actually have the luxury of thinking more blue sky. And so, a lot of work that I've done in my career is actually helping banks to like forward think a bit and say, okay, what's coming down the pipe? Like, what are the things that we need to think about when it comes to, say, crypto, for instance, because that's a hot topic right now. And I think that that's a very exciting thing that we do as, in fintech, is being able to work with the banks and really help them plot out, what their product and service offerings are going to look like going forward. I think a big part of that is risk management. So, these are financial products that are, their risk profile varies on the spectrum. But I think when we're talking about, things like hedge funds and investment banks and whatnot, these are fairly risky assets, which create risky portfolios. And, prudent risk management is actually essential to running this business. Regulatory compliance has been a huge area over the past 15 years, ever since 2008. And it's just waves and waves and waves of regulation and compliance. So if we think about the banking industry, which was deemed too big to fail back in the early 2000s, and when they did, and we saw the ripple effect, regulators stepped in and started intervening. And I think, just to give you an example, like back in the day, prior to all of these regimes such as Dodd-Frank, and you'll hear about things like EMIR and GDPR, like in the consumer space in Europe, you'll hear about all these sorts of regulations. And prior to these regulations, a lot of transactions were just a matter of picking up a phone. Hey, I wanted to buy 100 shares of XYZ, done, and the deal was done. Today, if we look at a highly regulated environment, a single transaction could basically call out hundreds and hundreds of compliance checks. So, if we think about like being able to buy or sell, to structure a transaction with a counterparty, just to be able to go through like, dozens or hundreds and hundreds of checks that have been mandated by all these different, geographical, regulatory mandates. That's something that you need technology to keep on top of all the different regulations that you need to be compliant with. And then, as the trader or salesperson, you need like the machine to help you process through all of these checks, because if you get, 10 red flags, now you have to process through all the 10 red flags, right? So if you think about what was a complex environment with regulation and compliance, it's made it even more complicated, and that's where the technology comes into play. And that underpins all of the activities within the capital market space. So as part of that, process optimization and automation. So if you think about just regulatory compliance is really just two things. It's all about reporting data down, so saving that down into a data warehouse somewhere, and then it's reporting it out. So it's reporting it out to whichever regulatory body oversees, that particular activity. So now, if you think about the multitude of data, that's where things like automation comes in, because now you need to have, software that can actually, keep on top of like all of these deadlines and reporting requirements.
So do those end up adding on top of each other? I mean, I'm just imagining the SEC comes out with, I don't know what they call it, we'll call it a guidance that you need to now collect this piece of data for this type of transaction. It hasn't happened in the past. Would you expect a new startup to pop up and say, okay, we're going to solve this. This is what we do. We are going to give you a tool to track this piece of data and like back populate stuff. And then you just have like a house of cards of all of these solutions built on top of each other. And then somebody else probably comes in and says, my job is to integrate everything, all of this house of cards. We're going to add some structure to it. Just help me understand how.
That's right.
Okay.
I mean, we're talking about petabytes of data that's accumulating. So, I've done some work with the regulators myself. And if we look at the credit crisis from 2008, the whole idea was to be able to monitor all of the derivative trading activity that was happening in the marketplace. And I recall, like, I was working with a regulator, and we were looking at a data model with over 40 million transactions. And these are all kinds of transactions. It's not like a simple equity, which is a quantity and a price. I mean, we're talking about 500 data fields, 40 million transactions, right? And basically, this particular regulator wanted to do an early detection system to be able to flag, like if there was concentration risk building up in a particular sector of the market. Maybe it was with a hedge fund or investment bank or group of investment banks. They wanted to be able to identify that. And so the challenge is, how do we make sense of this huge database of heterogeneous data that we are collecting? We've asked everybody to report this into us. Now, what do we do with that data?
With complex relationships too, I assume. Because like we're talking about derivatives, we're talking about underlying assets that are a million miles apart.
Exactly. So, I mean, we're talking hundreds and hundreds of fields that represent the different permutations of these transactions. And to be able to normalize that data, to be able to make sense of some sort of risk profile, enormous tasks. And I think that's where, the next point about data science and analytics come in. Because I think, you start to collect petabytes worth of data, and it's not, clean data either. This is very messy data that's coming in. The thing is, you need the machine to learn. I mean, humans, to process millions, if you don't do that 6 months down the road, that's going to be 100 million or 200 million, right? And it just gets to the point where you need to have something like machine learning or predictive analytics to be able to look at that data, identify patterns, and to basically, do something meaningful with that, make predictions.
Yeah, that's where I was going to ask you next. I mean, it feels like this enterprise fintech was probably some of the first applications of like truly big data. And then I guess my question is, did a lot of AI and ML come out of fintech and then was purposed elsewhere? Or is it the opposite, where people were figuring out AI, ML, and then it's now being put to use within enterprise fintech?
My impression is that it didn't, the innovation didn't happen in finance. Like AI, the whole idea about learning machine, that's been around for decades. What we didn't have for decades until just recently is we didn't have the data, and we didn't have the computing power to process that data. And a lot of that was outside of fintech. So I think if I look at the problem with industries such as capital markets and wholesale finance is that it's heavily regulated. So you can't just turn on deep learning neural networks
Sure.
like that. It doesn't work like that because it has to go through so many approval cycles. And on top of that, when you're using it for things like investment decisions, you need to be able to explain how that decision was arrived at. And that's the thing with AI is that because it's constantly learning, it's not like there's a path that you can follow to a decision, because that will change, right? That will constantly change depending on how it's learning.
But do you expect to see more and more and more artificial intelligence, machine learning work their way into the finance world? Are we going to disintermediate humans at some point?
Oh, absolutely. But I think it goes hand in hand with governance, because I don't think anybody will dispute the power of AI and how it can transform roles and industries and the way everything is done. The problem is when you have regulations that are around that, when you have audit committees, for instance, when you have investors that are going to say, let's say your AI went wrong and you lose money, and you have like big pension funds that are coming to you and say, well, what happened here? You need to be able to explain that. And if you can't explain that, that becomes a real problem.
Yeah.
Right?
Don't they just fire the most junior analysts and move on?
I think it's probably the opposite way around. But I think that's the thing, is that data science adoption will have to grow, with the controls around it.
Sure. Okay.
Does that make sense?
Yeah.
Okay. And I think, the last box here is really from an enterprise fintech perspective. It's a lot of consultative type selling, right? Because this is not just turnkey solutions that you buy and you turn it on and it all works. Like a lot of this is very forward thinking. It's like, how do you, achieve competitive advantage, increasing top lines, reducing bottom lines, whatnot, so it's basically saying, okay, we have all this data now. How does Twitter or Facebook or Google, like, how do they manage like these just fire hoses of data? Because this is what they do, and they do that very well. So how can we take all the learnings in those spaces, and how can we apply it to, say, the bond market, for instance, or, how we quote, equity prices on, level 2 feeds and things like that. So I think, that is another, that is part of the job, working in enterprise fintech, is that you are consulting on matters that are very forward thinking and helping these institutions like understand how to best leverage technology. Okay. So just a little bit about me. I've been involved with this industry for a number of years now, with a background primarily in sales and product. My focus, and I think my sweet spot, is that I like companies that are in the early to mid stage of their growth. So, not zero, but basically, first 10 clients, or first couple dozen clients to, their first 100 million in revenue. I think that inflection is a very exciting time. And it's, something that I've had the privilege of being part of on multiple occasions now. In terms of, my background is a combination of finance and technology. So, on the finance side, I have a lot of experience like looking at the trading world, valuations of complex products, risk management, regulation, portfolio management, and operations. From a technology perspective, as I've grown in this industry, I've gone through a number of cycles. So when I first started, back then applications were being sold as, UIs and boxed applications. And one of the early companies I was involved in actually sold APIs, which now is kind of bread and butter when you're integrating and, with the cloud and whatnot. But back then, the whole idea about just selling a toolkit with APIs as opposed to a UI was a new and novel idea. So enterprise software, APIs, cloud-based software. I think the issue with cloud, when you're trying to sell cloud solutions into a highly regulated industry, is that highly regulated industries such as finance are very protective of data and what data can actually leave the four walls. So that's been the big challenge with cloud providers, is that yes, they can provide all this fantastic CRM functionality and whatnot, but how do you work with these highly paranoid institutions and highly regulated institutions to allow some of that data to pass beyond their firewalls? So that's a challenge. UX designs become a very important component, which has been adopted more from the retail markets. And then, lastly, just managing big data in the form of BI work and data science. So yeah, and just in terms of my background, some of the work that I've done in my time is selling, trading system API toolkits. During the mid 2000s, when right before the credit crisis, some of you may have heard of something called credit derivatives and the structured finance market and CDOs, CMOs. And basically my job was to sell credit derivatives, structured finance, and structuring trading systems to investment banks and hedge funds. So I did that from 2005 to 2008, and then the whole world blew up. And so, when it comes, just to loop back to like my involvement with firms such as Bear Stearns and Lehman Brothers, for instance, I was actively working with those firms and, selling them trading systems and risk management systems, because everybody wanted to jump on this whole industry at the time, which was securitized products. And it was basically sort of like this kind of unfettered time where everybody was just originating mortgages, packaging those mortgages up into, securitized products, issuing bonds and writing derivatives off the back of that. And then, it was a house of cards. So when everything imploded, everything fell. But yeah, so that's how, I got involved with that particular market. I think off the back of that, a lot of the focus since then has been around things like risk management, what's called market structure utilities. So now, rather than just banks trading with each other, now banks would trade with each other, but they had to report all of that trading activity to these central hubs. And so when we look at firms like the CME, for instance, they are the clearing houses for derivative transactions. And the idea is that if you want to see what's going on in the marketplace, or at least in North America, you can look at the CME, and the CME will work with the regulators. So that kind of gives you single point of visibility into what's going on and what the risk is in the market. And so those, I held product management roles in a lot of these companies, and it's what I continue to today with, doing more product related work. But, some of the other things that I'm, quite proud of and to have taken part of is, looking at things like open source. So, within technology, the open source space is very important and it's very powerful. And, I was involved with a company that basically open sourced analytics and risks. So if you look at, historically, banks and hedge funds, they hired, armies of quants, for instance, to develop analytics that allowed them to price a trade better or to risk manage better. And we thought, why not, standardize all of that, seeing as how the world was standardizing after the credit crisis anyway, and basically open source that analytics so you could be, in your bedroom with some cash that you made off of your .com startup. And if you wanted to start your own hedge fund, you could basically just download some analytics and, away you go. And so that was a very interesting paradigm shift. And yeah, so, that's taken a life of its own. And then, lastly, there's just been a whole slew of compliance mandates that financial institutions need to abide by these days. So that's what I'm very much part of today.
A question about that open source analytics. How has that performance been? Have you tracked the performance of those sorts of systems and seen what sort of returns they're generating? I know they're not prescribing a trade necessarily, but does it hold up?
Well, I think this is the thing. It's when I'm talking about the analytics, like I'm not talking about adding alpha to your portfolio. It's
Okay.
basically if you have a bond or if you have a derivative transaction, what, given the yield curve today, what's the price of that transaction? So that's just telling you what it's worth and how to value it. It's not telling you that if you trade it right now, you're going to be making, X percent profit, right?
You should
So
make that app. I'd like that one, please.
so I think there are companies that, Python-based companies that allow you to do that, to create trading algorithms. But, typically that is a black box. That's a secret sauce for any trading house.
Okay.
Yeah. Okay. So just to, call out a few examples of things that I've worked on. So I've worked for companies that have started market structure utilities. So one of them now processes over 2 trillion in transactions. So this is across foreign exchange products, equity derivatives, et cetera. So once a trade is done, all of that information flow and the associated processing flows through that. I got involved with that company when we had 3 clients. And now it has over 2,000 participants that sit on that utility and is part of the capital markets infrastructure today. Second, I'd mentioned credit derivatives trading and risk. I mean, this was a time, where, we're working with a lot of mortgage originators, investment banks that were securitizing those mortgages and then passing it on. So, those trading systems, you can think of me as the arms dealer back then, where I was providing the technology that assisted in them conducting those activities. 3, so MSCI. So I worked at a company as a startup, and I joined as a credit risk product manager. And what the company was doing at the time was actually standardizing the methodologies for measuring market and credit risk in the system and, across banking portfolios. So, again, similar to what we were doing with the open source, is that we had very transparent methodologies. We provided the data sets, and, all institutions had to do was load up their portfolios, and that's what they, could use to see and measure their risk. So again, I was involved with that from a 65-person startup, and ultimately they got bought by, MSCI, which is one of the larger fintech players today. And then Ion Trading, which is a name that, again, most people have probably not heard of, but basically in terms of execution platform, so they provide execution platforms. So when banks are actually executing trades on the marketplace, those types of platforms, which again are governed by a lot of regulatory compliance. I worked, for that, where we advised a lot of other investment banks on, how to implement different regulations. And then once we had that, to establish tools like what's called trading surveillance. So trading surveillance is like internally, you have all these regulations in place, but how do you know when like a trader's going rogue? Like, have they managed to circumvent a process? Like, are there detection signals or signs that you can glean off of the data that's coming through and, use that to throw some early warning signals? So those were the types of products or projects that we would work on. Okay. I think for the audience here, what's probably more interesting as opposed to what I did was really, what are the opportunities in the space? Is, I'm sure that this is an area of fintech that probably not many people know much about. And, this is just my opinion. But, the one thing is that there is this whole world of crypto, DeFi, distributed ledger technology. And that's very interesting. And the reason why it's very interesting is that if we think about banking and capital markets, is that by its very nature, it's an intermediary-based industry, that you have all these participants that sit in the middle to broker transactions, and they collect fees and spreads, and that's how they make their money. And what crypto and distributed ledger technologies have introduced is a way to disintermediate. And I think that, has struck the fear of God into a lot of financial institutions and market participants. But it is the future because, smart contracts, distributed ledgers, etc., they have like that is the disruptive technology, and it's just a matter of time to see how that gets applied. Off the back of that, there's predictive analytics. So, we are institutions, the whole industry is collecting tons and tons of data. Now, be able to leverage that data and to monetize it in the same way that Amazon and Netflix and Google have used it is definitely on the roadmap. Automation to basically start to streamline all the manual processes, within these organizations, I think is, another huge area. All of this is obvious. A lot of it is driven by compliance and regulation. But the thing is, there's so many regulations that these institutions are subject to that, if that's an area of interest, there's a lot of that type of work going on. The cloud is a very interesting area because, as I mentioned earlier, it's that the cloud inherently sits outside of the bank's four walls. So the thing is, how do you get these regulated, paranoid institutions to basically allow their data to flow between the cloud? And I think, a lot of what you will hear is that a lot of these cloud providers, even though the information is kind of flowing out on the network, they probably have more expertise to secure the data than a lot of, banks have in-house to secure their own data. So that's interesting. And then I think, lastly, I have collaboration and optimization here. And the idea behind that is that there are a lot more utilities out there in the marketplace these days that say, rather than competing with each other directly, are there opportunities where, we as, say, JP Morgan and Goldman Sachs can work together and basically, can we collaborate on certain initiatives? So the thing is, we might be holding 100,000 positions against each other, and to hold a position costs money. Can we do the same thing with 50,000 transactions? So, there's the ability to collaborate and optimize, and that's, that's definitely a new paradigm shift. Okay, so just a little bit about, what are some of the perks? Obviously, I think when people think about working for tech companies, there's like the free food, there's all like the swag, free coffee and booze. And I think the motivation for financial technology, especially in the enterprise space, is very different. Like it's a very, it's a mindset, it's a lifestyle, it's a geographical preference, sort of opportunity. Here you work with incredibly smart people in finance and technology, right? Because you're working with the best of finance and technologists. It's typically not a field that you learn about or can get any working knowledge in school. So, working in this industry is a working by doing, and sort of that's how you gain insights and that's how you build your network, like most industries. It's a great industry if you like big cities. So if you want to live or travel to New York, London, Singapore, Hong Kong, Dubai, that's where most of these firms are located. The hours are very good. So if you think about typical industries that new graduates want to get into, like banking or consulting or technology, in contrast to technology, consulting, and typical investment banking advisory, the hours they tend to be pretty regular. And that's because the market works on market hours. So, you don't tend to burn the midnight oil like you do in these other industries. And it's a very fast-paced, high risk reward industry. Okay.
One question.
Mm-hmm.
I'm imagining you start a tech company or you want to start a tech company and you're choosing between doing some sort of data handling, data security for healthcare or finance, right? It can be a health tech or a fintech. Does the simple proximity to money around being in fintech do anything to valuations or to like exit multiples or anything that you're aware of?
I would say it's almost the opposite of what you might think. In the sense that because you're around big dollar values when it comes to trades, like, like I've been around, multi-100 billion dollar transactions, and those get executed on a daily basis. But how that doesn't necessarily translate into a valuation multiple for the company, because if you think about firms that are able to execute and trade like such large positions, if you look at like TAM, when you think about like the startup marketplace, how many addressable firms are actually conducting that kind of activity, and it's few,
sure, yeah,
right? Yeah, so it's there's the thing about vertical industries, and this is very much a vertical industry within fintech, but the thing is it can segue into very big money positions, like if you can, like myself, you can use this as a segue to get into hedge funds, and hedge funds, if you get into the right roles there, pay very well. And I think the difference between fintech, and if you want to use that as a stepping stone into like the trading, sales and trading industry, is that where working for a startup is all about vesting, right? It's about annual bonuses and vesting and how well your stock does. Whereas if you look at capital markets and something like sales and trading, it's about how profitable you are in managing a portfolio, and that can pay out, much more frequently. Right?
Sure.
So that's a little bit of perspective there, like just purely from a compensation perspective. So, what I wanted to leave you with is enterprise fintech for me? And the answer would be yes. If you're interested in finance and technology, and you can't really decide between the traditional routes like banking, consulting, big or small technology. If you're keen to learn about like the inner workings of how the capital markets work, so things like exchanges and brokers and hedge funds and asset managers, insurance companies, and what they all do, this is a great way to get a lot of broad exposure that way. If you're interested in financial services and want to take, sort of more of an offensive stance, you can go to work for one of these institutions or focused on targeting these institutions. And, they're a fairly old industry, and they're in, a lot of the projects these days are about digital transformation. So like, how do you apply machine learning and AI, or what about crypto or distributed ledgers? Like, what are the use cases? Like, banks are always looking for talent that can help them, make those big leaps. Or if you want to go on the offensive and you want to disrupt, what is a somewhat antiquated, guarded industry and fairly opaque, there are the fintechs of the world that are looking to take on the 800-pound gorillas. Like if you look at Square or PayPal, looking to disrupt, payments and even consumer banking, the same sorts of activities are happening in the different tiers. Like if you look at companies like Amazon Web Services, and as they're starting to look at areas like insurance, or as they're, starting to do lending, for instance, a lot of the new offerings that they have tend to resemble what sounds like banking. And so, I think it really just depends on your personality, where your interests are, whether you want to kind of help existing incumbents, like, basically transform themselves to become more competitive with technology, or if you want to take the route of a disruptor as a startup and take on the 800-pound gorillas directly, join a startup and see if you can, take over and basically make some of these old processes, and basically disintermediate them. And that's it. So that was the end of my presentation. So, I hope that was a bit informative and, not too opaque, but, happy to take any questions.
Yeah, that's great. I love the last thing you said about disrupting the 800-pound gorilla. I think a lot of folks really like that idea, and the kind of the tech startup world of sticking it to the incumbent. So it's be a fun place to do it. We actually really don't have time. That was a great presentation. I think I interrupted you way too much, where it's just about 1 p.m. But I did have one thing I really wanted to ask. And you kind of talked about the players are paranoid and there's so much regulation. How does an institution who's thinking about working with a vendor or a fintech startup balance the possible value add versus the additional exposure around kind of cybersecurity, right? The more people you bring to the party, the more chances there is for somebody to put you at risk of losing security of your data. So is there a way that folks tend to think about that?
Yeah, and I would say very long due diligence cycles. I think that's the one thing, some of the inner workings and the dynamics of working for a fintech is that, you might get a letter of intent signed with an institution, but you may not have a signed contract for another 12 to 18 months.
Mm-hmm.
And the reason for that is exactly what you're talking about now. It's that, when we look at security, what happens if there's a breach of security? Are we going to put anything in escrow, right? Like, is there going to be code or money put into escrow? And what happens in the case of a breach? And I think that's, that is the problem to solve for this industry, is that because it is highly regulated, because it is highly walled, the data is so vulnerable. So, I think that's a huge opportunity. Those who can figure out how to crack that nut, that's a big barrier that they've overcome if they can do that.
Sure. Well, hey, Dave, many thanks. This was great. It's always fun to hear about people that are deeply knowledgeable about topics that I don't know anything about, which is a lot of topics, it turns out. So really appreciate your time and you sharing your wisdom with the group. As a reminder to everyone, this is the last event of the winter series. We're going to take a quick break and then we'll be back on April 1st for the first of our Fundamentals for Hardware Startup series. Please watch your email for the schedule and we will see you all then. Until then, everybody have a great weekend and we'll talk to you soon.
Great. Thank you.